Hi guys, it's Loy here, and in this video I will explain to you uh, what is the Wyckoff distribution and how it affected the Bitcoin crash 2 days ago. Um, but before we start, what is the Wyckoff distribution? So the Wyckoff distribution is one of four patterns that Richard Wyckoff found. He did not invent; he actually found it in the early 1900s. So this famous trader slash economist was born in the late 1800s, 1873 to be exact, and he's one of the famous traders out there that I follow, alongside with Elliot, Gahn, and Fibonacci. So this guy found four distinct patterns that is very common until this day. So this pattern is common in a lot of markets. It does not happen all the time, but it happens often. And we'll go through these four patterns that he recognized. The first is the accumulation pattern, accumulation schematics 1. This is today we don't call this accumulation schematics 1. Today we call it a falling wedge. So a falling wedge pattern is exactly the same pattern as this. You get lower lows. However, these lows are not that much lower than the previous low, so it's like a falling wedge. And during a falling wedge, you often get a bullish divergence on RSI, and that's one of the patterns you will recognize in a falling wedge pattern. The second pattern he found was accumulation schematics 2. This today we like to call this an inverse head and shoulders, and the pattern is exactly the same thing. So you have the left shoulder here, the head, inverse head, and the right shoulder. And once again, when this forms, you get a bullish divergence on RSI. And the third pattern he found was the distribution pattern, number 1. This was the rising wedge pattern, which we initially saw. And the fourth pattern, which is the distribution pattern, number 2, which is what we like to call today the head and shoulders pattern, which I actually posted last week, as you can see here. See how the pattern is the same? The pattern is exactly the same. So you have the left shoulder, the head, and and the right shoulder, and you also get a bearish divergence. As you can see, you have higher prices here, but the RSI is lower than the previous. So that's the bearish divergence you get. So yeah, Richard Wyckoff was the first to identify these four patterns that we commonly use nowadays. But during that time, he believed that this pattern was a result of market manipulation, which I don't agree. There will always be some market manipulation, but I believe that there are too many players in the market for one to have that much effect on the market in total, especially if the market is as big as Bitcoin. Like it's like if you're reaching if any market is reaching nearly $1 trillion market cap, it's hard for one player to manipulate the prices to that extent. But I do believe in manipulation, just not total manipulation. So this guy did believe that back then, but today we like to believe that most big markets cannot be fully manipulated. Like certain manipulation for sure, that's a given. But I believe that these patterns is just a representation of uh, the market psychology. So the psychology of traders. So these common patterns is just a representation of how the overall market or the overall like consensus, the market consensus, and how they trade and the psychology. And it just represents the supply and demand. Like for example, what we had was the Wyckoff Distribution 2, which is a head and shoulders pattern, right? In plain English, it essentially just means that the buyers are dying off. So you have a lot of there's not much there's not much demand, a lot of supply and not much demand. And when you get that scenario, you have buyers turn into sellers because buyers want to see a return on their profit. So once they don't see any more return, like when Bitcoin starts to stall, you exactly get this rising wedge pattern. So a rising wedge pattern it's just a graphical representation of a commodity where the price is stalling, like price is not going much higher. See, this high was barely like a few thousand higher. The March high is barely like a few thousand higher than the February, and once again the April high was only like 3,000 high. So this is what you call a rising wedge. And when you get that head and shoulders pattern, or in Wyckoff's method, the distribution pattern number 2 is exactly the same thing. This is a very bearish pattern. So the distribution 2 pattern is very bearish. Head and shoulders is exactly the same pattern. It's just a modern interpretation of the Wyckoff method, and it essentially just means the price could not break the previous highs. And after a rising wedge, and if you combine a rising wedge with a head and shoulders pattern, it's super bearish. And that's the reason why we dropped to about 30,000 2 days ago. So there you have it. That's my explanation of the Wyckoff method. So it's essentially, it's nothing new. Well, he was the first to find these 4 patterns, but nowadays these patterns are commonly traded in a lot of markets. And yeah, you'll see that often in, I've seen this often on gold, on stocks. Yeah, so it's a very reliable pattern. I remember I posted a technical analysis video like last week before the crash of this pattern. It's exactly the same thing. It's the same as the Wyckoff Distribution 2, and as we can see, we did drop, and there you go. So it's just a lot of sellers trying to sell their Bitcoin because they could not get any more return on the Bitcoin. That's essentially what happened last week. When you get a price stall, you will always get a correction. So there you have it. That's my interpretation of the Wyckoff method and how it applied to Bitcoin in the last few days. If you like my video, please give me a thumbs up, and if you don't like it, please give me a thumbs down twice. And if you want to see more videos, subscribe to my channel, and remember to hit the bell icon so you can get notified when I upload a new video. Thank you.